All friends, I am Jagender Rana, and the topic of the day is insurers to diversify operations. Insurers to diversify operations. The finance ministry has proposed allowing insurers to diversify operations beyond insurance business. A draft proposal inviting public comments talks about diversification, giving insurers the ability to offer guarantee and indemnity services, manage and sell repossessed properties, and establish employees' welfare funds for staff and retirees. The draft proposal talks about letting insurers engage in activities incidental to promoting insurance. However, another proposal from the Insurance Amendment Bill 2022, which specifically talked about permitting insurers to distribute financial products like mutual funds, was dropped in the current draft. Market experts argue that specifically including this provision would help insurers to use existing network for cross-selling on par with banks distributing insurance products. Also, agency reforms under consideration could allow individual agents to represent multiple insurers working as independent financial advisors, which could increase agent income while offering choice for customers. So the draft is open for comments from stakeholders. Some insurers are preparing a response asking the government to explicitly include the distribution of financial products to take the benefit of cross-sector opportunities. Other proposals include allowing composite registration for insurers to operate across life, general, and health insurance under a single registration, reducing minimum capital requirement for insurers, serving underserved populations to not less than Rs 50 crore, and cutting the net owned fund requirement for insurers from Rs 5,000 crore to Rs 1,000 crore. Also, registration for intermediaries could become perpetual against need to renew every 3 years at present. The major reform is proposing FDI increase to 100%. Penalties for non-compliance and misstatements are significantly raised, with fines up to Rs 10 crore or Rs 5 lakh per day. The government has asked for public comments on the draft until December 10, 2024. So that has gone, and the comments must have received. The market experts argue that specifically including this provision would help insurers to use existing network for cross-selling on par with banks distributing insurance products. Also, agency reforms under consideration could allow individual agents to represent multiple insurers working as independent financial advisors, which could increase agent income while offering choice for customers. So the draft is open for comments from stakeholders. Some insurers are preparing a response asking the government to explicitly include the distribution of financial products to take the benefit of cross-sector opportunities. Other proposals include allowing composite registration for insurers to operate across life, general, and health insurance under a single registration, reducing minimum capital requirement for insurers, serving underserved populations to not less than Rs 50 crore, and cutting the net owned fund requirement. So the major reform is proposing FDI increase to 100% penalties for non-compliance, and misstatements are significantly raised with the fines up to Rs 10 crore or rupees 5 lakh per day. The government has asked for public comments on the draft until December 10. So, must be the regulator is reviewing the comments and the feedback received. Because India's insurance industry is on the brink of transformative changes with the anticipated introduction of the Insurance Amendment Bill. So during the winter session of Parliament, this landmark reform builds on past efforts, primarily the Insurance Amendment Act 2021, under which foreign direct investment in Indian insurance companies was increased from 49% to 74%. Under the bill, the government is likely to have no FDI cap in the insurance sector and permit foreign investors to own up to 100% in Indian insurance companies. So, in addition, the government is considering the issuance of composite licenses, thereby permitting an insurance company to offer all types of insurance under one license and entity. So, despite the current limit of 74%, many foreign players continue to hold stakes below 74%, with control in the hands of their Indian joint venture partners. In fact, some foreign insurers have or are considering exiting India due to regulatory restrictions on control of joint venture companies. So it is felt that the removal of the FDI cap altogether will attract new entrants and address the sector's need for greater capital to fuel growth. Currently, life insurance companies are barred from offering health or general insurance products and vice versa. So, a composite license will allow insurers to consolidate their operations and reduce compliance burden and costs. So, this proposed reform will align with best practices in mature insurance markets like the UK and Singapore and will enable the creation of bundled products such as policies combining life and health insurance. For Indian insurers, this will offer an opportunity to diversify their portfolios and remain competitive in a dynamic market. Foreign insurers will also benefit by being able to simplify their different joint ventures and consolidating operations. So, in addition to the foregoing, the bill also introduced several forward-looking reforms like broader financial distribution. Insurers will be able to distribute other financial products like mutual funds, loans, and credit cards, creating new revenue streams and offering integrated solutions. Mutual fund has to be reconsidered, and then reduced capital requirements. The bill may lower entry barriers by reducing the initial capital requirements for insurers, currently at INR 100 crore, that is US dollar 11.8 million approximately, and reinsurers INR 200 crore, that is US dollar 23.6 million approximately. So by tailoring minimum capital requirement to a company's size and operations, the bill seeks to lower entry barriers for smaller niche players, thereby encouraging innovation. And then captive insurance licenses. Large businesses may be permitted to set up captive insurance entities to manage their own risk, giving them greater control over risk management. And dynamic investment regulations. The Insurance Regulatory and Development Authority of India will have more flexibility in revising investment norms in line with market needs, potentially improving return for policyholders. The last one is agent free to sell from multiple companies. The bill is likely to permit individual insurance agents to sell policies of multiple companies, eliminating the existing restriction that limits to one life and one general insurer. So these reforms reflect the government's intent to modernize India's insurance sector and make it more dynamic, competitive, and consumer friendly by opening the doors to 100% FDI and addressing structural limitations. The bill has the potential to align India's insurance industry with global standards. While fostering innovation and growth, this can also attract more global players, especially if they can exercise greater control. So the bill, once implemented, will enhance insurance penetration in India. For consumers, this will mean better insurance products, competitive pricing, and improved service delivery. All in all, the bill promises long-term benefits for all stakeholders. So certain important changes are likely to come very soon because the industry is witnessing changes nowadays. Expanding beyond traditional insurance core business to new opportunities and models is the requirement of the day. See, maturity in the insurance market is forcing players to explore business opportunities beyond their traditional core to ensure growth in an evolving insurance environment. Ensure growth in an evolving environment that is highly influenced by new technological trends and consumer habits. So traditionally, insurance companies have focused on maximizing new sales and investing in new products, channels, and segments. So after years of consolidation, however, lending players have amassed large customer portfolios. Acquiring new customers has become increasingly costly, as winning over customers from rival firms requires great effort and significant spending on marketing. So in a market where diversification within and outside the core business is increasingly found to be a success factor for companies, insurers must consider new value propositions to guarantee future sustainability. The leading players are already exploring and entering alliance with companies from other markets, as well as joining digital ecosystem, opening the gates to new audiences to target new niche products, additional added value services, and improved digital processes are examples of the latest trends among insurance companies seeking to expand their offering beyond a well-known, mature, consolidated core business. So, key amendments to the insurance acts will improvise the market because India's insurance industry is at the cusp of transformation. With the anticipated introduction of the Insurance Amendment Bill, this landmark reform aims to improve market penetration, foster competition, and encourage innovation. As the insurance industry prepares to welcome some of the most notable amendments, insurers may look forward to assess their strategic and operating readiness, allowing them to take advantage of these reforms. Insurers may use this as an opportunity to meet the evolving needs of their customers and equally prepared to operate in an increasingly dynamic environment characterized by a possible influx of new insurers and ecosystem players. So after 25 years of building the industry's foundation, insurers may witness a complete overhaul leading to a brighter and inclusion-driven India. The government plans to introduce a transformative bill that will be a significant step towards achieving insurance for all by 2047. Because currently, life insurance companies cannot offer health and general insurance products, and vice versa. So, a composite license will allow insurers to offer the entire range of products. This proposed reform will align with best practices in mature insurance markets like the UK and enable bundling products such as combining life and health insurance. So this will offer Indian insurers an opportunity to diversify their portfolio and remain competitive in a dynamic market. Insurers may look to develop a comprehensive strategy to develop or to leverage opportunities presented by the composite insurance licenses. This could involve making strategic investments, enhancing organizational capabilities, and aligning the operating model to deliver a seamless customer experience across a diversified product portfolio. The, the change can potentially bring in significant capital, global expertise, and innovative practices, which are vital for a capital intensive industry like insurance. For domestic players facing challenges to scale or drive partnership with banks or brokers due to the lack of ability to deliver a superior customer experience may borrow capabilities from foreign arms, creating a level playing field in the insurance market. Thank you. Thank you very much.